Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing company reports into something you can actually understand. Today we are diving into Phoenix Plus Corp's latest report, and let me tell you, this company seems to be riding a roller coaster of financial twists and turns with numbers that might leave you scratching your head. Before we get started, if you're tired of corporate jargon and want straightforward analysis, make sure you subscribe. Join our Discord community, linked in the description below for even deeper discussions. Let's jump straight into the numbers, starting with the balance sheets. Think of it like a snapshot of what the company owns and owes. One of the first things that jumps out is the cash. Phoenix Plus had about $156,000 in the bank at the end of April 2025. That's significantly less than the $34,000 they had back in July 2024. This means they are burning through their money. Is this bad? Not really, but we have to pay attention in coming months. Trade receivables, which is money owed to them by customers, stayed relatively flat at around $11,000. This means that their business is probably not booming, as the company doesn't seem to be selling a lot more and being owed a lot more money. Plant and equipment, which are things like machinery and computers, are also pretty consistent at around $20,000. This indicates perhaps that they haven't invested in much equipment. Their operations and business hasn't changed much. On the liability side, their long-term lease obligations decreased from about $31,000 to about $8,600. Good thing. This means they are paying down their long-term debts. Trade payables, which is what they owe to their suppliers, increased from $81,000 to $108,000. They owe more money to their suppliers. Total current liabilities, which are debts due within a year, increased substantially to $313,000 compared to $213,000 last year. Stockholders' equity, representing the owner's stake in the company, took a big hit, decreasing from $677,000 to $315,000. It means half the company is now owned by debt if they liquidated today and paid the debt first. Moving to the statements of operations, which show how well the company is making money. Revenue for the 9 months ended in April was only $320,000 this year compared to over $1 million last year. That's a huge drop. Cost of revenue also decreased, but not enough to offset the revenue decline, leaving them with a tiny gross profit of just $31,000. A huge change compared to a big loss from last year. General and administrative expenses actually increased, reaching $415,000, eating up that already small gross profit. They are spending way too much money compared to what they are bringing in. The bottom line, a net loss of $346,000 compared to a net loss of $369,000 last year. Still a big loss, and they don't have much equity. They need to start reducing it or find money. Now let's check on the cash flow, the lifeblood of any business. They used $56,000 in operating activities, less than the $509,000 used last year. As bad as it seems, they are burning slightly less money than last year. They need a lot more cash and fast. Investing activities didn't use much cash at all, just a bit to purchase equipment. Exchange rate changes hurt them a little bit, but not too much. Overall, their cash decreased by $278,000, which explains why their bank balance is so low. Alright, let's dig through the fine print. It's like a choose your own adventure story where every choice is between more accounting and auditing policy. And one thing that stands out is the going concern. Basically, the auditors are concerned that the company may not be able to continue operating, which is fair based on our observations. The company has a ton of authorized shares but has not issued more, which could create cash yet. They wrote off their entire equity method investment, a previous investment in Vetten City Angels SDN. BHD writing it off since the Malaysian courts were doing a winding up. All their revenue is coming from installation services in Malaysia. Their business is not diversified. They recognize the customer concentration risk. With a few customers providing most income, there is a risk of losing them and going down to zero. It seems like there may be legal issues. So what's the overall picture here? Phoenix Plus Corp is facing some serious challenges. Revenue is down, expenses are high, and their cash is dwindling. Now, let's shift to my personal take on Phoenix Plus. The report paints a clear picture of a company struggling to stay afloat. High expenses and dwindling cash is a very concerning combination. The over-reliance on a few customers makes things even riskier. They have a unique opportunity in green energy, but they need to become more diversified. In conclusion, the company is going to be trading for very cheap, considering the low valuation and the large risk. It might be an interesting option. Alright, that's our breakdown of Phoenix Plus Corp's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.